Hey everybody, my name is Kyle Knott and I am NotYourAverageFinanceGuy.com. This channel is dedicated to helping you break the chains of the big banks to get out of debt and to live your financial life on your terms. Not what the big banks teach you, not what they send the lobbyists to Congress and try to put all this information out. They never taught any of this stuff in school, but I like to scour the internet, YouTube, books, whatever you can, and I love this information. I'm passionate about it, so I started this channel to help you guys understand it as well. So today we're going to be talking about infinite banking policy loans. I've got a couple different videos on the infinite banking strategy, the concept, and I had a question the other day about loans. So I was like, all right, well, let's do a quick video and we'll do a little education on some loans here. So let's see, let's get my face out of the way. Cash value. So basically, in infinite banking concept, there's a cash value component of this program. So the cash value is guaranteed to grow. It's contractual obligation between whoever owns the policy and the life insurance company themselves. Again, these things have to be designed correctly, but cash value is guaranteed to grow. On one of the policies I've got, I think it's guaranteed at like 2 or 3%. I don't remember what it is, but on top of that, as long as you've got the right company, it's a mutually owned company, which means you are the owner. So then you participate in the profits of the company, which means it's a dividend. There's a dividend payout. We only use a handful of companies, and they have paid dividends every year for well over 100 years, all the way through the Great Depression, everything, the war, World War I, II, almost since the Civil War, honestly. So these are very good companies. They've been around forever and they pay dividends. So the 2 or 3% that's guaranteed it's always for over 100 years been more than that. So there's your guarantee. You have access to this cash value as needed. So it's on your schedule. When do you want it? Do you not want it? Do you want to leave it in there and let it all grow? Let the cash value keep growing, compounding, and this thing grows at a compounding rate. We leave that there. We let it go. If you want access to it, you've got access anytime you want. It doesn't really matter. Okay. You can get a loan for any reason. You can, maybe an emergency comes up. Who know? No one knows when something bad's going to happen. If you've got that cash value there, you can take a loan against that and you can help get yourself out of a jam. This literally is my emergency fund. Okay. Everyone says to keep 6 to 12 months expenses. Someone even said keep 3 years of expenses somewhere. Like who the hell has that? But what I've got here is I've got this cash value. If something happens that I'm not anticipating, which that's what an emergency is, right? You've got access to some more capital that you can then take for whatever reason you want. You can use it for college. You can use it for investments. That's what I normally do. I build up the cash value to a certain point, and then I use that as a down payment on a rental property, and then the rental property that kicks off the cash flow. I use that to repay the loan, and once that loan is repaid, I've now got a cash flowing asset that I will hold forever, and it's spitting a couple hundred to a lot of hundred of dollars every month, and that then goes back into my account. As soon as I pay back my cash value, I can build this up. I go make another down payment on a different asset, another cash flowing asset. Use all of that then cash flow from the two assets. You repay this loan as fast as possible. Get that. Now you've got two assets that are continuously churning out money. I'm making money when I sleep. I don't have to spend my time. I don't have to trade my hours for dollars while doing this kind of thing. So use this mindset to keep growing. The more assets you have that are paid off, that you don't own anything more on. Yes, I still have a mortgage on them, but tenants are paying that off. So whatever, I don't care. I'll let that work its course. And then in, 20, 30 years, they're paid off. And then it's just more cash flow. I could, if I wanted to, take some of my cash value in my life insurance and I could knock out a mortgage payment. A lot of my mortgage payments they've been around for a little while. They're 4%. I don't want to pay that off. I think it's really cheap money. And some people might think otherwise. They hate debt, can't stand debt, and that's fine. This gives you options. You can do whatever you want with it. You don't have to ask the banker. You don't have to do any of that stuff. You don't have to go down and have them check all of your 401k statements and everything else. It's nuts everything they ask for. So really, you can get a loan for any reason. Cash value is the collateral for your loan. So I've talked about this in previous videos. If you've got a house, say your house is worth, easy numbers, $500,000, and you owe $250,000 on it. So you go down to the bank, and the bank will give you a home equity line of credit because your house is worth this. It's worth $500,000, and you owe $250 on it. So you've got a $250,000 of equity in there. If you go down to the bank and say, "Hey, can I take out a $100,000 loan because I want to do something. Maybe it's some of this stuff." And they're going to look and say, "Okay, well, your house is worth $500,000. You owe $250,000. So if you take a $100,000 loan against your house, yeah, that's fine, because if you don't pay this $100,000 loan back, we're taking your house." Kind of the same concept, except they're not going to take your policy here. The insurance company will look at your cash value, and then they see, okay, well, let's use the same numbers. Let's say that you've got $500,000 of cash value. And if you've got $500,000 cash value, come back and say, "Hey, I would like to take a loan for $250,000. They don't care what it's for. They don't ask. They say, "Okay, now if you don't pay this $250,000 loan back, they will take your cash value when you die." So that's just less that your heirs get upon your death. So this is a life insurance policy. So that's kind of how it works. And what it is, it's a loan, and they know, like, I just looked through my policy right now, and I think I'm eligible to take, because I've already got some loans out, I can take about $90,000 right now. But if I take that, my death benefit right now, if I die tomorrow, is like 1.6 million, and it's only going to grow for the rest of my life because of the way this whole thing is put together. So even though these are loans, if you don't pay them back, which you should if you want to keep buying more assets and buying more things, but if you can't, don't want to, whatever, don't pay it back, and then the interest that you would have to pay back just keeps growing until you die, which hopefully is way down the end of the line. But you've always got death benefit available to take care of that. That's why the company gives you these loans. So that's kind of how they work. And you can usually borrow about 90%. You can usually borrow about 90% of your cash value within about 30 days of funding your policy. So every person is different. Every situation is different. That's why we would like to talk to you and see what your goals and how do you want to use this and make it the best for you, because you might have different goals than me. I'd like to hold on to those low rate mortgages. I know some other people that like, hell no, I don't want anything to do with mortgages. I'm not paying all that interest up front. I'm okay with it. Some people aren't. I mean, everyone is so different, and that's why this thing is so fluid. You can kind of do whatever you want with it. There really are no rules to what you can use this money for. It's guaranteed. You don't have to. They don't check your credit. Okay, it's a contractual obligation that they have to give you a loan if you've got the cash value available. So again, if you take out, say you got $1 million of cash value and you've already got $850,000 worth of loans out, they're not going to give you another $1 million, because they know if you don't pay it and you die, your death benefit won't cover it. So you've always got access to this money as long as you don't keep getting the loans and sending it right out the door. So, but that's also another strategy you can do. A lot of people I know that will put the money into the policy, and then a month later they pull it right back out and they'll put it into an investment. And some of them have no plans of ever paying that back, okay? But their cash value is still growing. Guess what? In 30 years, it really doesn't matter, because that cash value is so big and it's compounding daily that it just keeps outgrowing what they've taken out in loans. So they take out the loans and they're putting in other investments that are, and they're making more, they're compounding over here. So you're literally compounding in two different places. And then if and when you die, guess what? We're all gonna die. You've got it working in two places. And then if you die, when you die, boom, there goes another death benefit. Granted, at that point, it's going to be a lot lower because we've utilized a lot of the cash value, but it will still be something. So just some things to think about. Like I said, I had a question on that the other day. So please let me know if you've got any other questions. There's my website. Please go ahead and check me out there. And it's very simple, but if you got any questions, you can definitely get in there, get my email address, and shoot me a question. Love to hear and love to help you out. All right, good luck, everybody.